So, what are you waiting for? The question is usually asked with a sense of impatience, right? But the person being questioned, the one who is waiting, for some reason seems to be having a hard time deciding or acting. So why is that? Well, often this waiting is caused by a sense of uncertainty, which they hope will be resolved by events in the future. A recent survey done by the Certified Financial Planner Board of Standards, completed in early August, revealed that 63% of Americans are currently deferring. They're waiting on financial decisions until after the election. The same waiting on investment and capital spending behavior has been reported by U.S. businesses. Individuals are likely waiting because almost 4 in 5 Americans expect their personal finances to deteriorate if their preferred candidate fails to win the presidency. People have a decidedly negative view of the candidate they are not supporting. But the same survey shows that 58% of Americans expect the November election will positively impact the U.S. economy, presumably because they think their preferred candidate will win. 65% of Democrats and 61% of Republicans expect positive financial outcomes from the election, while only 40% of independents do. Perhaps the independents are just less happy with the candidate choices. Regardless of people's attitudes towards candidates in the upcoming elections, financial markets and the economy just finished off a very good 3 months. First Trust Economics observed that the S&P 500's year-to-date total return of 22.1%, quote, marks not only the best start to a year since 1997, but also the strongest first 9 months ever recorded in a U.S. election year. Remarkably, they write, the S&P 500 index reached new all-time highs 43 times this year, closing the quarter at one of those record levels, close quote. In the recently completed third quarter, the S&P 500 was up 5.89%. Now, the Russell 2000 index of U.S. small company stocks gained 9.27% for the quarter. The tech-heavy NASDAQ was positive, but less so, rising only 2.1%. Really, one of the biggest contrasts in the U.S. market with previous quarters was the performance of big tech names like NVIDIA, Microsoft, Alphabet, and Amazon, whose stocks were all down from July through September. That is a change. Outside the U.S., international stocks added to portfolio values. Stocks in the MSCI All-Country World Developed ex-US Markets Index were up 8.17%. Companies in the MSCI Emerging Markets Index saw their shares rise by 8.88%, supported by China's stock market surging 24% in the month of September, as the Beijing government sought to aggressively stimulate growth there. In bond markets, most interest rates finished the quarter lower after the Federal Reserve, as anticipated, lowered their target rate by 0.5% or 50 basis points in September. Lower rates across virtually all maturities, combined with the higher bond yields already in place, they moved the Bloomberg U.S. Aggregate Bond Index up 5.2%. That's higher for the quarter, significantly. Inflation continued to slow, with the last reported number showing headline CPI at 2.5% year over year through August of 2024, falling from 2.9% in July. And the labor market strengthened, producing 254,000 new jobs in September, lowering the unemployment rate to 4.1%. Now, this lowering of inflation while maintaining a strong labor market, that's the kind of soft landing the Fed is trying to achieve for the U.S. economy. All in all, a very positive quarter for markets, investors, and the economy. And this all in spite of the increasing political rancor and the approaching U.S. election day. By now, most of us are weary of election year political campaigning and advertising, especially if you live in swing states where media spending will again break all kinds of records. Leading up to Election Day, expect predictions of catastrophe if this or that candidate or party wins. Expect those predictions to only get louder. Based on previous election year data, it's also likely that markets will experience spates of volatility between now and November 5th. Now, in light of all this, it's worth reminding ourselves, perhaps every week, that financial markets, particularly those in the United States, have proven to be strongly resilient regardless of which political party is in control of the White House and Congress. Historical data by BlackRock shows that since 1926, in presidential election years, stocks have risen on average 3.3% just in the fourth quarter. A 2016 study by Charles Schwab and Company found that the S&P 500 rose an average of 6.7% in the first year of a new president's term. And a 2024 study by Capital Group found that investors who remained fully invested or made monthly contributions during election years consistently outperformed those who stayed out of the market. So the takeaway here is that while we may feel like joining those 63% of Americans who are deferring financial decisions until after the election, doing so, particularly with our portfolio investments, is not supported by the data. Educated optimism is needed more than ever as all parties involved in the upcoming election ramp up negative, truth-stretching political speech. Regarding the power of optimism, psychologist and Nobel Prize winner Daniel Kahneman wrote, quote, "If you are allowed one wish for your child, seriously consider wishing him or her optimism. Optimists," he goes on, "are normally cheerful and happy and therefore popular. They are resilient in adapting to failures and hardships. Their chances of clinical depression are reduced. Their immune system is stronger. They take better care of their health. They feel healthier than others and are, in fact, likely to live longer." Our goal as we prepare each episode of Financial Perspective is to give you the information and encouragement needed to grow as an educated and prepared optimist. And if you're listening to this as a podcast, you can help us spread this message of educated optimism by liking us on your podcast app. If you'd like to hear more about the upcoming election and how the candidates' policy announcements or leaning could relate to your personal financial plans, we invite you to join us at 11:30 a.m. Central Time, Wednesday, October 23rd for Elections and Your Money, a webinar hosted by Foster Group. Jason Brown and I will discuss an overview of economic and tax policy issues, go into more detail on historical market reactions to elections, and we'll also discuss planning opportunities that may arise regardless of who wins or loses. There will also be time for participants to submit questions during the webinar. You can register at our website, www.fostergrp.com/events. As always, thanks for investing some of your valuable time and attention with us today.